Good afternoon and welcome to everyone to this new session of Trinity Talks. I am Mariana Sedefian and I am partner in the Paris office of Trinity, and I will be moderating today's talk, which will be held by partner Kaushik Ray in London. This is part of a two-part session of Trinity Talks on PRG products. Yesterday, Joe and Simon talked about a PRG, what is a PRG product, the context of a PRG documents. Joe talked in detail about the structure of PRG documentation and talked about the eligibility criteria and other considerations to bear in mind. Today, Kaushik will be doing a deeper dive into some PRG issues. He will be going through some frequently asked questions about those structures. I will look at some of the specificities of the French Francophone market, and we will be doing a little compare and contrast and talk about other political risk mitigation tools such as political risk insurance. So now I will pass you to Kaushik, who will start today's talk.
Thank you, Mariana. So I'm not sure if everyone can see the slides that are up there, but just the first thing to say is a little reminder of why we are here. So we are talking about partial risk guarantees in particular, but clearly that's part of a wider political risk mitigation strategy that any project would have. So here at Trinity, we have a lot of experience working with political risk mitigation products, but including PRGs specifically. And as Simon mentioned yesterday, we've worked on them in a number of jurisdictions, particularly in Africa, but also in other parts of the world. Not only have we negotiated them, we've also drafted them on behalf of public sector clients. We're going to talk a little bit today also about other political risk mitigation products, for example, political risk insurance. Mariana will talk a little bit about the Francophone aspects, because I think everyone assumes the PRG is really based on Anglo-Saxon law documents, or either English law or New York law documentation. But there are some things that really need to be considered in the context of guarantees in Francophone countries, which Mariana will touch on. And then in the context of a deeper dive into PRG products, we'll look at some FAQs. And very helpfully, yesterday in the session, we had a Q&A, and we had a good 15, 20 questions arising out of that. We answered some of them in yesterday's talk, but we'll be doing a response, or we'll be trying to respond as best as we can to some of those questions also today. So then on the next slide, just a reminder of the kind of world we're talking about when it comes to political risk mitigation products. We've done this as a pie chart, but clearly there is overlap between some of the products, meaning that sort of you can pick and choose really what type of products and structures you would utilize in any project financing. So yesterday we discussed the World Bank PRG products. Other providers are of course available, including African Development Bank and Asian Development Bank as examples. Political risk insurance is one of the items that we will talk about today, and we'll also talk about what are often called PCGs, partial credit guarantees, which are guarantees, sometimes guarantees of debt that are offered by DFIs and multilateral agencies. On the left-hand side of this chart, we've just noted a few other credit enhancement products that address certain types of political risk. They can include currency risk mitigation, first loss products, subordinated debt, grant funding. All of these things can be used in a project finance context to credit enhance for political risk purposes. On this next slide, we've just got a list really of example providers of credit enhancement products. It's a long list, so I'm not going to sort of go into detail with all of them, but it just goes to show you how much is out there we've focused on some of the products issued by multilateral development banks, in particular by IDA and IBRD, the World Bank. But from a look at that list, you can see that there are bilateral development finance institutions, regional guarantee facility providers, and as mentioned in the previous slide, there are ECAs and private insurers as well. So that was just to give a little bit of a flavour of really how broad and how wide this topic can be. On the next slide, this is a reminder of what we're talking about in terms of a typical PRG structure. So this is taken from an actual transaction. This is largely the structure that was put in place for example, the Azura IPP transaction in Nigeria, where there are two PRG products, and Joe and Simon talked about these in some detail yesterday. They're set out in red on the slides. The debt mobilization PRG, for whom the beneficiary is covered lenders, what are called covered lenders, effectively eligible banks, often commercial banks. And then the liquidity PRG, so that is a product that it's a guarantee that's offered to a letter of credit issuing bank, and that issuing bank issues a letter of credit to a project company in respect of 3 to 6 months worth of off-taker payments. So I'll turn to Mariana now, just with that kind of structure in mind, to talk about some of the specificities that need to be borne in mind for Francophone markets.
Yeah, thanks, Kaushik. Yeah, a few words on some specificities for the Francophone market. As you mentioned previously, the PRG products are very much inspired from the Anglophone practice. So when trying to transpose those practices into the French or civil law systems, we see that we can have a few difficulties. In the PRG world, we have an LC, as you mentioned, and the LC is issued by a bank. And under the PRG structure, this LC is a first demand guarantee with, however, a mix of events that result in the LC being suspended or events that result the LC being terminated. And here we should take some careful attention to the drafting of this kind of product under French law. Why am I saying that? Is because under French law, we have two types of personal guarantees. We have the first demand guarantee, which is codified in the civil code, and the same type of guarantees exist as well under OHADA law, and all these are inspired from the UCP or UNCITRAL principles. Under this kind of guarantee, which is developed by banking and business practice, the first demand guarantee is an autonomous obligation of the guarantor to pay under the guarantee. The obligations of the guarantor is also independent from the debtor's obligation under the underlying agreements, which means that the guarantor may not raise any defense or objection resulting from the underlying agreements, nor from the relationship between the guarantor and the debtor. Why I'm saying that is, as mentioned before, in a PRG world, an LC, we may have some termination events or some suspension events, thus having a link with the underlying agreements. And it is quite important to be very careful in the drafting of this kind of guarantees, because if there is too much link with the underlying agreement, then it could be qualified as a cautionnement or surety bond under English law, and under which the guarantor may avail himself of the defenses that may raise the principal obligor. And this is for sure not something we would like to see in a PRG product. So the boundaries between the civil code guarantees and the first demand guarantees can be quite arduous, and those two guarantees can come even closer depending on how the payment obligation is drafted and within actually in the guarantee agreement. So now I will pass it to you, Kaushik, to go through a few Q&A.
Yeah. Thank you very much. Thanks very much, Mariana. And just what Mariana's saying there is, it's really, really important to ask the question, if you're in a Francophone jurisdiction, is this product going to work, even if it's governed by English or New York law? Is it going to work in the wider context of the state offering a counter indemnity sitting behind the guarantee? Or indeed, if the product is being offered by an entity that is drafting the suite of documents under French or under laws, then definitely something to bear in mind. And Mariana and I have worked on that. Mariana's an expert on that, so please do come to us if you have any particular queries on PRG instruments in Francophone countries. So turning now to the FAQs or Q&A. These are indeed questions that come up very often, and so I think it's worth answering them one by one and giving our best view for the time being. Clearly, a lot of the questions warrant quite detailed responses, so we'll be giving brief responses here. You should feel free to email myself, Simon Norris, Mariana, or Joe Sykes at any point if you have any questions on PRG instruments. So the first one that came yesterday: can PRG be provided to sub-sovereign entities? Well, the answer is yes, sort of. The PRGs themselves can be provided to covered lenders, and they can be provided to letter of credit issuing banks. So in respect to the liquidity PRG, ultimately, the obligations that are being taken on, or the obligations that are being guaranteed by the PRG provider, are in respect of a sub-sovereign entity. So, for example, in Kenya, a PRG product could be put in place to cover off 3 to 6 months worth of KPLC's payment obligations under a power purchase agreement. But always note that in almost all cases, there will be an overlying indemnity agreement that is directly between the government. So in that example, the government of Kenya and the relevant member of the World Bank Group, so IDA, for example. That leads neatly on to the next question: is a counter indemnity or an indemnity agreement always needed? So the answer is usually yes. It's certainly the policy of the World Bank Group that a counter indemnity agreement is needed. However, we have seen recent transactions, including World Bank Group transactions, where the indication is that this may not always be required. So certainly that non-requirement is something that we're seeing newly in the market for the first time, and there may well be members of the World Bank Group who are watching, and we're certainly happy to have an understanding and a further discussion as to what those criteria may be. But we certainly have seen instances where a counter indemnity is not required, but certainly as a rule of thumb, I would say yes, it is always needed. For some other PRG providers, not necessarily. So a lot of multilateral agencies or development banks are effectively treaty organizations, whereby countries sign up as members, either as shareholders, as equity members, or otherwise as non-financial participation members. And as part of those equity arrangements, subscription arrangements on the treaty, there are provisions that provide the relevant PRG provider with some comfort that any product that's offered by that multilateral in the country will effectively be covered, reimbursed, guaranteed, indemnified. It really depends on how the treaty itself is worded by the host government. So general rule of thumb, World Bank, yes, counter indemnity or indemnity agreement is needed. Likewise for the African Development Bank, but there are institutions for whom it's not needed because they rely on the treaty obligations. It's worth saying that even when they rely on treaty obligations, very often there is a letter of non-objection or an MOU or something that kind of sits alongside, maybe a one-pager, that just confirms that the host government is happy that the product is introduced into the country. Next question is on timing. So how quick are the World Bank to respond to PRG requests and to execute transactions? And I think it's an important question to ask, especially amongst the current situation and the emergency funding that a lot of multilaterals and DFIs are deploying in the COVID crisis. I would say from our current practice on, I think between us as a firm, probably 30 plus active transactions that are at that development stage across the continent, possibly more. Ones that are requiring PRG, we're not currently seeing significant delays. It seems to be progressing at sort of normal speeds, but it is a good question to ask. That sort of experience, clearly our data points are generally relatively limited in the entire PRG universe, but we're not currently seeing any significant delays. And I think it would be fair to say that, generally speaking, whilst there are significant timelines to putting in place PRG documents, we haven't generally found those to be the cause of the delays in getting your transaction to financial close. So then the next set of questions, very good and very difficult question about capital adequacy and whether the PRG is recognised for Basel purposes. Now, just to contextualise the question, if you are a covered lender under a debt mobilisation PRG, what you want to be able to do is go to your credit committee and say, for capital adequacy purposes and for my host country regulator, I'm going to need to account for this loan that I'm putting out the door. If it is effectively guaranteed in some way by a PRG, that would greatly assist. The general point is that the credit exposure that results from a partial risk or partial credit guarantee is certainly generally less than for direct lending, because you've reduced the amount of default events and you've effectively reduced the underlying amount of exposure accordingly. However, certainly our understanding from having done World Bank Group products with covered lenders, the answer is no. And the reason is mainly because of the ability for the World Bank Group, IDA, for example, to suspend or terminate that cover, which basically means it's not 100% sure guarantee, even though the documentation is very clear that in certain circumstances that guarantee protection will be provided. There are suspension and termination events. Now, it's worth pointing out that things may have changed. We're talking about Basel rules and also central bank regulatory rules. So things are, we are always in an evolving environment. But from our experience, the basic answer to the question is no. On the flip side, if you're a letter of credit bank and you are issuing LCs under a liquidity PRG, for some PRG providers, the answer is yes, there is recognition for capital adequacy purposes, both at local regulator level and under Basel. RLSF, the Regional Liquidity Support Facility, which is a PRG-like instrument offered by ATI with cash backing from KfW. Under that structure, there is relief for the letter of credit bank in respect of capital adequacy. However, that also involves a secured cash element to it, as well as a guarantee. So the characterization is quite specific in that case. For partial credit guarantees, which we'll come to towards the end of the talk, PCGs, or other full political risk guarantees like those, for example, offered by the European Investment Bank, under capital adequacy rules, those guarantees do provide zero risk weighting to the guaranteed obligation. So even though a PRG may not provide it, a PCG may. And as I say, we'll come on to that at the end of the talk. Next questions. Next question. What's the impact of PRGs on project LCOE in the energy sector? How important is it in a renewable energy project to reach financial close? So absolutely, you're always looking to reach the lowest cost of energy. So this is a question about cost, really, cost and timing. There certainly is a cost element in putting in place PRGs, both actual costs, so your upfront fees, your ongoing fees, commitment fees for the LC bank, for the PRG provider, and of course, tons of lawyers. And many lawyers, not Trinity, but many other lawyers are very expensive, and they'll need to have their bills paid. On top of that, there is a development lead time, and any lead time will lead to increased development costs. As to whether it's important in the renewable sector, totally depends on the overall risk analysis of the country, of the off-taker, and of the relevant government authorities. There are plenty of renewable deals that close without credit enhancements like PRGs. Where they're larger transactions or where they're first in country, they are very, very often utilized. And they're very often utilized as an adjunct in a programmatic approach, like a scaling solar or a GetFit. They can be used as add-ons to those programs. So what's the impact? Yes, of course, it does increase the pricing, but then it reduces the credit risk, and some of that can be offset by cheaper pricing on the debt side. Next question. Do we think the fact that the PRG provider endorses at the end of the day the obligations of the public party make it also an advisor to the public party on its obligations in the context of their negotiations with the developer? It's a good question, and actually it raises a couple of questions about what the role is of the multilateral, what the role is of the World Bank, because on the one hand there are products to put in place, but obviously they're policy driven. So what is the policy for the country? Inevitably there is a tie, there is a link to the provision of the products and general country-specific policies of the World Bank group, or if you're talking about AFDB, for example, likewise. Generally, though, I think that slight, not necessarily downside, but that sort of linkage to wider policy objectives, which may not always fully be aligned to your transaction. If you're a developer or a lender looking at a transaction, you're not necessarily always looking at the wider macroeconomic context. But I think that negativity is very much offset by what we call the halo effect, which is the fact that you will have a very strong partner at the table. There will be high-level assistance in getting transactions done and closed. Again, subject to that slight caveat that if it doesn't fit within a policy objective, then clearly you may run into trouble. A good example of that is, for example, if you're an early investor in a country, in a real frontier market, and you're doing the first transaction in that country, then the expectation of your IRR, the expectation of your tariff may be higher and may be validly higher. If you're then looking for, or you or your lenders are looking for PRG protection to cover off-taker risk, for example, and that's being provided by a multilateral institution, that multilateral institution may well look at the tariff and think, that's a little bit high, and from a policy perspective, we don't want the off-taker and ultimately the government to be on the hook for such a high tariff. So there is definitely a little bit of a balance to be had there. Now, I'm not sure if that's exactly the question, that is what I feel that the question was getting at, but it is very important to note that the majority of the PRG providers, in fact, I think really all of the PRG providers, are multilateral institutions that do have very specific policy objectives, broadly speaking, in terms of sustainable development and poverty reduction, but it is important to always bear that in mind. The next question is on transferability. So does PRG affect the transferability of a loan? If consent is required for the World Bank for transfers, but or for assignment of the guarantee, have you seen a situation where consent is refused or delayed? Again, a very good question and a very practical one. So typically, the drafting will say that a guaranteed lender may, without the consent of the guarantor, assign, transfer, or novate its rights and obligations, provided that the incoming entity, the new lender, is an eligible financial institution. And that eligible financial institution definition will vary, but it will generally mean that you have to be a financial institution, usually excluding DFIs and ECAs, which are not eligible generally for PRG cover, and that entity is not sanctioned, is not either sanctioned by UN, EU rules, or by the internal policies of, for example, the World Bank or African Development Bank. So therefore, generally speaking, there are restrictions, but not consent. Where we have seen consent requirements, I have to say that generally speaking, and again, you know, taking just from our experience, so from those data points, we've generally seen pretty quick responses from the World Bank Group, particularly compared to other institutions. So certainly from our side, that's not a significant issue. The next and kind of last, again, excellent question, which will lead us neatly on to the next topic. Please clarify the difference between PRG and PRI. Does World Bank offer both products, and what is the advantage of one over the other? So what we've been talking about is PRG, a partial risk guarantee. So there's a definition up there: financial product provided by entities such as the World Bank Group that guarantees private sector lenders or investors against the risk of a government failing to perform its contractual obligations with respect to a project. And we talked yesterday, Simon and Joe talked about this debt mobilization PRG, and we've talked about the liquidity PRG. PRI, political risk insurance, it's an insurance product, and it's provided by either commercial insurers, by DFIs, or also multilateral agencies, and they provide that financial protection, really just as basic as an insurance policy as you can imagine, to lenders and investors who otherwise would run the risk of losing their investments or their returns because of political events that are the responsibility of the relevant host government. So to answer the question further, yes, World Bank Group offers both. Political risk insurance is provided by MIGA, the Multilateral Investment Guarantee Agency, PRG generally by IDA and IBRD. You very much can have both on a transaction. We worked on transactions where both products are used. There's an overlap. There's a world, or there's a Venn diagram of where you may not need them because they could be addressing the same risk, or you could, for example, have a PRG specifically only addressing liquidity, i.e. is the off-taker making regular payments, but your investors want something wider. They're going into a country for the first time. They want general political risk insurance for the government breaching the terms of its guarantee, for example. So very much you could be in both worlds. So just looking a bit more then at PRI, political risk insurance. So who provides it? The number one obvious candidate is actually export credit agencies. So export credit agencies like COFAS in France, like Hermes, like K-Exim, US Exim, they are effectively there to support their home country's exports. So, for example, EKF, Export Credit Fonden out of Denmark, will provide guarantees and insurance products to either investors or to lenders where Danish goods, for example, Vestas wind turbines, are being used. And the same applies for all ECAs. So they can be insurance products. There are agencies like ATI, the African Trade Insurance Agency, which is a multilateral agency, sort of born out of the auspices of the African Development Bank, but it is again a treaty organisation with member countries. I think 14 or 15 member countries and some associated members, and an entity like ATI will provide trade and commercial and political risk insurance for companies and businesses and lenders who are entering into markets that either they're unfamiliar with or where there is an element of political risk remaining. Commercial providers also provide political risk insurance, so AIG, Lloyd's, Zurich, all of the big insurers can provide. Always worth checking via your broker at the time what the state of the market is. A number of brokers very helpfully provide monthly updates as to the state of the market and really the state of pricing of the market. And their job really is to assess all kinds of risks, but political risk is of course a large one in emerging and frontier economies. You can have this sort of hybrid solution where there are commercial insurance products put in place, and behind that there is reinsurance, and that reinsurance could be provided by, for example, MEGA, for example, DFC, formerly known as OPEC. So there's a world of sort of sometimes seemingly hidden and unknown products and structures out there. They all go to address the same thing, really, the political risk. In the last slide, or the next slide rather, this is just, this is not a real deal, but I've taken examples of other political risk mitigation tools that can be used in a project. So you can imagine any project that you've worked on. So on the left-hand side, you have your equity investors. Now, your equity investors may well say, I'm not fully comfortable with the government support package in country X, because although they've got a decent payment record or a decent balance sheet, I'm just not convinced. I want to get some additional protection in the event that some type of political risk occurs. And that could be as simple as a breach of contract. It could be an expropriation event. There are lots of categories of insurable risk that relate to political risk. So they go to an insurance broker, and Lloyd's of London puts together a syndicate and says we can cover this risk up to X percentage of your investment. That package, that insurance package, can be reinsured by a DFI. So, for example, let's use OPEC, or DFC as it's now known, as an example. So DFC could sit behind and actually formally for OPEC it would have to be a US insurer. So let's use AIG as an example. That requirement has been softened or removed as part of the change to DFC. But let's imagine that it is AIG and DFC who are sitting behind it as the reinsurer. What does that do? What it does is it reduces the pricing. It reduces the premium that you as the equity investor would have to pay to your insurers to provide that political risk insurance. Moving to the middle of that slide. So this is an A-B loan structure. There are lots of different types of this structure. A very normal A-B loan structure is where a multilateral like EBRD, for example, provides a loan to the project company. It also provides an A loan to the project company. It also provides a B loan where ultimately the named lender could still be EBRD, for example, but sat behind it and providing the funding could be a commercial bank. And the advantage for the commercial bank is that it would benefit from some of the protections of EBRD or the multilateral, like, for example, preferred creditor status. Sometimes it's not the commercial bank that actually provides the funding itself. There are structures where the commercial bank itself guarantees the relevant multilateral, and the risk in respect of political events sits with the multilateral. So if there's a commercial failure of the project, then the commercial bank would take that risk. But if there is a political failure, then that will be taken by the multilateral. These are detailed products. They've been used in a number of transactions. There's an EIB structure that was used a lot in offshore North Sea transactions. In Europe, something similar has been used on the Lake Turkana transaction, fairly common with both with IFC and EBRD, in varying degrees, but that's sort of an AB loan structure or potentially a partial credit guarantee structure there. On the right-hand side, as previously referred to, there can be an ECA involved, and that ECA could either insure or guarantee a senior lender in respect of potentially 100% of its debt, and typically that would cover political events. ECA cover is sometimes also available for commercial risks, and often just available for political risks. So we're coming to the end of the Trinity talk. Marianne, I don't know if we've had any additional questions that have come in through the Q&A. If it's worth answering any.
Thanks a lot, Kaushik. Well, actually, you went through a very deep into dive the PRG product questions. I mean, I learned a lot thanks to you. I have a question for you. Actually, it's with respect to currency. We have seen together that the PRG structure is like a big puzzle, and it's quite difficult to navigate through all the different and various documents. So how would it work? Could we have LC, which is in a different currency than the underlying obligation? Have you already seen that?
It's a very good question. It's a very good question, Mariana. Yes, it's actually a very tricky question because the currency risk has to lie somewhere. If you're a large multilateral development bank, the likelihood is you're able to lend and transact in multi-currencies, certainly in dollars and euro, at least in hard currencies. You may also be able to transact in sterling. For those institutions, it's probably a little bit easier for them to take that risk, and then behind the scenes they would do whatever back-to-back hedging that they would have. If you're an individual, like a bilateral agency providing the PRG, and you're providing it, for example, in euro, but the risks that are being covered are payments denominated in US dollars, then yes, there is a potential currency mismatch. Usually the currency mismatches are dealt with in the PPA and in your underlying documentation, because very often actually they could be payable in a foreign currency, but they could be denominated in the local currency, and you might have reconciliation mechanics in the PPA itself. So the basic answer to your question is it very much depends on the detail of whatever the transaction is to see how the currency flows go. Ultimately, if there's a bit of a gap, somebody is going to have to either take a view or take the risk. The likelihood is that where that risk should really lie is with government. But if it's a bilateral agency that is only able to offer a product in a single currency, there's probably a strong argument that actually that agency should be taking the risk if it's going into a country where the transactions are undertaken in a different currency.
Thanks.
Sorry.
Thanks a lot. Thanks a lot, Kaushik. So, well, you already answered to a lot of questions, very complicated, and with respect to this very complex matter. Would you like to add something more?
No, I think that's probably bored everybody sufficiently. I guess just to say, well, thank you, Mariana. But these are really complicated topics. We've tried to keep Trinity Talks as, you know, sort of bite-sized chunks of information to give everyone a flavour of the topics. We are absolutely here and available for detailed questions. Please do feel free to drop us a line. Just a bit of a note here on upcoming talks. Next week is our last before a summer break, where my colleagues in DC, Tom Eldred and Eric Philippink, will be talking about a special relationship, so comparing New York and English law in project financing, which I think will be a fascinating talk. And then from September, we've got a whole slew of weekly topics, from the latest on LIBOR, a spotlight on Ghana, a deeper dive into de-risking investments in the off-grid space, and we'll also be looking at OFAC and an introduction to US sanctions laws. We're actually programmed all the way up to the end of December. If there are ever any topics that you as a client or as a audience member want us to cover, please feel free to drop any one of the Trinity team a line, and we'll program it in. But for me, thank you very much, and I'll wish you well. I'll hand you back to Mariana to just wrap up.
Thanks, a big thanks to you, Kaushik, for all this precious advice. And we hope you enjoyed our talk today. You can find all our talks on our website, and see you next week. Bye.